Now, with China's recent currency depreciation and stock market routes, many global institutions are predicting the world's second biggest economy will fail to meet its economic growth target of 7% for the latter half of this year. Kwon Soa reports.
Although China managed to reach its target of 7% growth in the first half of the year, the chances of that happening in the second half of the year look to be less likely. A rate of 6.9% is the average that 15 major financial institutions are predicting. The IMF and OECD's forecast stands at 6.8%. Economic figures from last month are adding to concerns. China's on-year industrial production dropped from 6.8% in June to 6% last month, and both exports and imports plunged more than 8% compared to the year before. Experts say China's slowdown is a result of its policies focusing on overinvestment and a surplus in stocks. The recent stock plunges are also a barrier to the real estate market, which is responsible for around 15% of the nation's growth. Concerns are mounting that this will have an impact on Korea and other Asian nations highly dependent on China's exports. Korea's benchmark Kospi dropped to below 2,000 when China depreciated its currency a week ago. But some analysts say it's not going to be that serious.
It could affect the stock market, but we already experienced that. With exports already declining throughout the year, we don't expect a bigger shock in the second half of the year.
According to Korea Development Institute, however, every 1 percentage point drop in growth in China could mean up to a 0.17 percentage point drop for Korea's growth. Kwon Soa, Arirang News.